welcome to BloombergQuint. The mega IPO 197 Communications Paytm, as we know it, is now very close to hitting the street. It opens on the 8th of November. Shares have been priced in a range of 2,080 to 2,150, and that values the company at roughly about $20 billion. Joining us to talk about the IPO, which is incidentally India's largest, Vijay, Shekhar, Sharma, and Madhur, Deora. Thank you both so much for taking the time to speak to us here.
My pleasure having me and Madhur here, Ira. It's quite a day, and it's good to see you here in the morning to talk about it.
Thanks. Let me get started so I don't waste any time. It's tough for me to talk about valuations with you all because we've covered traditional finance for years, and none of those traditional finance metrics translate into this company. But I do want to ask you all. It's a large size IPO. You all, through your roadshows, etc., are comfortable, confident that you'll be able to get that kind of money in at this valuation? What are the valuation benchmarks that you kept in mind as you finalize pricing, etc., with your merchant bankers? Either of you.
I would thank you so much once again, and I would want Madhur to answer. And before that, I also want to tell you that companies get valued for different matrices. Obviously, revenue and profitability are very visible and clearly out there. At the same point in time, Ira, I want to tell you that we've started this company not just for making money, but simply bring about the change in financial services, that we can bring formal financial services to the nook and corner of this country. Our target is not about revenue. Our target is primarily about bringing 50 crore Indians, 500 million Indians to the mainstream of economy. And that would be possible because consumers are changing, their habits are changing, smartphone is what they are committing and investing in, and there is an ability of using smartphone to do the financial transactions. Payment is a clear winner out there, and then we are seeing the banking. You and I are banking using smartphone, then I believe that a town and a village person will eventually do it in the next few years. That is what our bet is. Our bet is not about how much money we would make and what valuation we will take or have as a company. Our success will be benchmarked on, of these 50 million Indians, how many of them with how many of services in how many years we could bring to Paytm platform, or for that matter, on a formal accessing financial services. As far as this round or this IPO process is concerned, my Group CFO Madhur is here, so he can talk about it.
Madhur, also tell us why you didn't go ahead with the pre-IPO sale as part of this.
Oh, sure, of course. So I will just pick up from Vijay's point to answer the question, which is when your mission is to have impact on hundreds of millions of customers and tens of millions of merchants in India, GMV, revenue, contribution, profit, eventually cash flows follow. That's our belief, and there are enough and more investors. The good thing is, internet has been around for 20 years in other markets, creating very large outcomes for companies. So people see that once you're focused on users and their quality of engagement and what are the types of services that you can give, you see that huge pop in revenue growth and contribution profit and eventually cash flows. So as a result, I think there are enough and more investors out there who are very comfortable with this and have seen this and want to be a part of this. To answer your question in short, do we feel confident with the price band that we have? We feel 100% confident. And we could have, I know there were some market rumors about us being at a higher valuation and so on, and that could have been achieved. But one of the things that we said is, okay, let's price it at a level where everyone makes money, including all of our existing investors. So that was a thought process. Obviously, markets speak for themselves, but our thought process was we could have done this price band at higher, but this is where we felt more comfortable in terms of balance and having the really high quality investors who have seen this journey, who have a belief in this journey. The pre-IPO simply, Ira, is an option that people can have at the time of DRHP.
Yeah.
So when you file the DRHP, you can keep that as an option. Lots and lots of companies put it. My sense is only about 20-30% of the companies, maybe less, actually eventually end up using it. It's just an option. If you don't put it, then you can't do it, right? And for us, it just made sense for those straight towards the IPO and just have sort of a more equitable process where everybody could get stock as opposed to a few handpicked investors.
What I can secretly bring out part of process, because as a technology entrepreneur, it was first time for going on such a incredible process of meeting incredible investors and so on. I can tell you, Ira, not just we would have concluded our fundraising in private completely, but many times over, if we were to trust or given to or suggest that what many of such global blue chip investors were saying, I want this much allocation minimum, Vijay. Tell us how would you do it? Do secondary, do pre, do this, do this. And I used to pursue Madhur. I think Madhur, they just absolutely love us. They understand the business so well. Why are we not trying to do it? Vijay, you understand there is a process length and this would mean the following. So I was like, okay, I
So
get
there was
it.
a good balance basically between you and Madhur. All
And
right.
one of the things that we did, just to add, is that we increased the size of our IPO by about 10%, just to make sure that we can get right amount of interest from very large institutions. And that was also a strength of confidence of the interest that we were getting.
I'm going to get into the business now and sort of understand some aspects of it. And Vijay, to you first. So I mean, if one studies the financials, I think what you can see is consistent growth in GMV. And that's obvious. But on the flip side, you have seen a decline in the take rate, and it's been a steady decline, and it came down even in FY21. I'm curious to understand from you. I have some indication of why this would have happened, but I want to hear from you, Vijay, why it happened, and what is the change in the business mix that you would want to make to sort of reverse that a little bit, where GMV is growing, but take rate is also growing, or at least not falling.
So rule of thumb is that GMV to take rate is not what business metrics is. Business metrics is the customers come for payment and convert into commerce and financial services. That's a business model. So monetization buckets in payment is that we have Paytm payment instruments, which are like wallet, postpaid, and many other instruments that you have listed in DRHP, as you can note them. And they have a interchange side of the money, not the take rate MDR side of money. So either one of the things that you should know is that the difference between Paytm and other payment companies is that other payment companies don't make any money. I mean, if you note, if I was to trust what newspaper said and I was reading their annual revenues, Paytm could do it in 1.5 months, actually at a scale that we are doing as a revenue pipe. And this is just so that you can see that our business model very clearly is that bring the customers for payment, whether consumer or merchant, and offer them Paytm instruments which earn revenue, offer them subscription and cloud services which offer merchant side of revenue, and then expand them towards financial services, where, because we are one of the best distributor of these financial services to these customers, have our own percentage bips, as you may look at the number of size there, make money on that. So business model is actually not pivoted around that I would see increase of MDR. Actually, Ira, I want to tell you in this call to everybody in this country, if there is a 0% MDR, that is because of Paytm. We always champion 0%. We always champion 0% because that spreads. And I was quoted in a newspaper saying 0% MDR is a force multiplier of digitization. And that is very visible. If you charge the merchant for basic payment, they would not take it. If you charge the merchant for additional services, reconciliation, extra credit on the table, and every other service that you can give, merchant will happily give you because he's growing the business. So it's a very interesting mix that you need to see here. And that is what we benchmark on. So our payment revenues
That's
are
exactly
higher
what
than
I'm
ever.
asking, Vijay, that how will you shift that mix eventually? I mean, it may not be today, it may not be tomorrow, but at some point you want your business to become more remunerative, right? How will you change that mix? You've done the payment pipes. The payment pipes you already have.
No, Ira, it does. Our payment vertical revenue, which we now have declared in DRHP, you could see they are actually more than the cost that we incur in that. Surprise.
So I should just add that, right? So I think there's a slight tendency to look at the business as linear, where if you're making revenue from this thing, you should make more and more revenue from the same thing over time, and that's the only way business can be run. I think if you look at our numbers more closely, the one is, while the take rate has gone down, and Vijay said that we're perfectly comfortable with that, our contribution margin has actually gone up during that period, right? So we used to be like negative 50+% contribution margin 2 or 3 years ago. Last year we were -8. In FY21 we were 13%. In the Q1 that we put in the RHP that came out yesterday, we are 27%, right? So even as the take rate goes out, the contribution margin goes up, and that's really the model of you run payments as efficiently as you can. You make revenues only where you add value to the merchant. If it's just a simple payment, like a small merchant accepting payment using QR code, then they get it at 0. You don't make any money on that, and that's okay. But you run it, you charge where you add value, and you try to add more and more and more value. You run it as efficiently as you can, and then you do commerce cloud and financial services. That we believe is the business model. Well, we certainly know that's a business model for Paytm. That we believe is a winning business model, right? That is the business model which completely counteracts this force that you pointed out, which we actually believe in, that take rates in India should go down, right? So as a result, you'll see in the June quarter, our revenues grew 60% year on year, and our contribution margin went from 11%, from 11 million to $33 million, right? So 240 crores of contribution margin in the June quarter, 33% contribution margin. Sorry, 27% contribution margin, $33 million, which is significantly up from what we did previous years, despite the fact, to your point, that take rate went down, right? So that's
so one shouldn't, the message is that one shouldn't expect take rate to move higher, which I assume.
So I'm going to tell you, Ira, the trick, and this is an evolutionary trick. It takes time to be digested and understood by the business teammates, everyone, is that if a merchant is taking more number of payments using digital methods and our payment acceptance systems, Soundbox QR, EDC, etc., dynamic QR, payment gateway, the merchant's value in eyes of a lender grows up, because they can then give cash advance very easily to the merchant. If you're receiving 10,000 rupees a month, I can give you 10,000 rupees multiplied by 1 or 2 or 3 for next 12 months. Because I know that I can, as a creditor, can say that they can take a percentage of this money every month from his receivables. And if the trend is increasing, then it means that there is a collection cost reduction. There is a customer acquisition cost, that is what we take an advantage of. So our business model, Ira, is that making merchant take more payments, even, I mean, we continuing to challenge and change 0% MDR. I mean, we are going to take this on us, that we bring more people on payment platform in this country at 0% MDR. And we are talking about Paytm wallet at 0% MDR here for every small merchant there. Because once you bring them to accept payment, they don't have GST filed return. Nobody takes 1 crore rupees of obligation or 2 crore rupees of obligation, those borders that have been decided for GST returns. They don't file GST returns. They don't have formal compliances. This is the ultimate compliance of India's masses for SMEs. You can talk about 100 million Indians who are not formally having a job to actually have a cash flow that is benchmarked and digitized and trackable for any lender in this country. That is superpower. India GDP will not grow because payment is digital. India GDP will grow because payment being digital has enabled India's lenders to give credit. And that is where the credit is to be given. 0% MDR is a force multiplier of our growth and this country's growth. That's a shocker. No, that's a straightforward math.
Okay, I get that. Just coming off of that question, the two big areas which you seem to be focusing on is certainly now merchant payments more and more, and credit. Tell me, on merchant payments, Vijay and Madhur, what's the game there? Again, it seems like it's a deep pockets game, right? People who want to throw money and acquire more and more merchants can sort of get the upper hand, in which case you're up against equally deep pockets.
I think that is more true in consumer side, not in the merchant side. Okay. Merchant side, जैसे कहते हैं ना कि आपको मर्चेंट के जाने के लिए सारी मौतें मरनी पड़ेंगी, मतलब आपको सारे फ्रॉडस्टर्स के थ्रू जाना पड़ेगा, आपको फिजिकल सेल्स टीम रखनी पड़ेगी, आपको you will have so much of hard work to onboard a merchant and service a merchant at a SME level. अगर इस देश में किसी ने कराए तो वो टेलीकॉम ने करा, और वो भी उन्होंने मोबाइल वायरलेस से कर दिया. मतलब उन्होंने वायर तो नहीं पहुंचाना इस देश का अभी तक उस दुकान तक. इसका मतलब क्या है? इस देश में पहली बार एक कंपनी है जो ऑर्गेनाइज होके उस व्यक्ति के पास पहुंच रही है जो इस देश के कोने कोने में कंज्यूमर को सर्व करता है. और इसका मतलब है कि हमें वो सारी मेहनत करनी पड़ेगी जो पिछली कंबाइंड क्यूमुलेटिवली सब कंपनियों ने करी. ये हार्डवर्क नहीं, ये मैजिक वर्क है. ये इंडिया के एसएमईज को ग्रो करने का वर्क है. और इधर मैं आपको बताना चाहता हूं कि मर्चेंट फोकस जो है वो इस बात का नहीं है कि somebody can acquire merchant one day and next day there will be somebody else giving. If merchant was okay to switch because उसको 50 रुपए का और 100 रुपए का कैशबैक के क्यूआर रखने का मिल रहा है, तो वो मर्चेंट हमारे लिए बनाई नहीं है. वैसे इसीलिए आपने देखा होगा कि हम बहुत सारे मर्चेंटों की दुकान पे बारात लगी होती है और हम वहां पे जाके साउंड बॉक्स लगाते हैं और सब साफ हो जाता है. ये हमारा प्रोडक्ट है. हमारा प्रोडक्ट है कि कस्टमर को, मर्चेंट को हमारे प्रोडक्ट के द्वारा सबसे बढ़िया एक्वायरिंग मिलनी चाहिए, लोएस्ट कॉस्ट पे मिलनी चाहिए, बेटर सर्विसिंग मिलनी चाहिए, बेटर टेक्नोलॉजी मिलनी चाहिए. Ira, this is an inclusion.
So you're saying you have an advantage more than just cost, more than just sort of the money that you can use to spread out across the country. You have an advantage more than anybody else who can do the same thing. What is that advantage?
The perseverance and persuasion and the purpose. हर एक कोई इसमें पैसे बनाने आ रहा है, हम इसमें देश को बदलने आ रहे हैं. ऑल्ट्रिस्टिक लगेगा, नेशनलिस्टिक लगेगा, बट कोई और मोटिवेशन हो नहीं सकता. जितनी मेहनत करनी पड़ती है, जो रिटर्न है ना, उस अगर ये मोटिवेशन नहीं है तो हो नहीं सकता.
Madhur, the shift towards merchant businesses, from a financial viewpoint, give me a sense of, is that going to be a high expense expansion given the sort of, the spread out nature of the business?
So, Madhur, मैं आपको I can speak on the commercials also. I'll give you a simple math. If a merchant is acquired for 1,000 rupees or 2,000 rupees, the LTV of this merchant for financial institutions is a lot more than that. That is what the game is. Short answer. If you think about this merchant whom you acquire for 1,000, 2,000 rupees, there is a money that he would pay you for cloud services and subscriptions like reconciliation processes and integrations into the system. And then he will pay the money, or we will make the money, because a financial institution actually wants to extend credit to them, and they want to give us as a percentage of acquiring fee and percentage of collection fee. So either the business model is actually so sound that we, just because we are in IPO process, and I cannot quote a forward-looking number here, and I mean it sincerely here, we are super bullish on acquiring merchants. Super bullish stands for the number of recruitment of field sales executives and their integration into our system is incredibly more. And one more thing I want to share here is India's journey of economic growth to the consumer and masses will happen through large corporate, small corporates, small businesses, SMEs, micro SMEs, and then consumers at that place. If we empower this small shop there by virtue of taking payments, and by virtue of that, he can get a formal financial services, including bank account, including his credit because of that, and then including some insurance that he otherwise would have not bought. The truth of the matter is that his life will be far more fulfilled and scalable and successful, which we don't have to feel bad about. Ulta, we need to feel happy about, because other financial institutions are able to make a reach. I want to put it on the table here. I'm sure you would have seen the large banks of this country or NBFCs of this country partnering with Paytm.
Yes, I was just going to ask you about the HDFC tie-up actually.
Think about it. The very reason that we can do it is because their cost of acquiring that customer is so enormous that at a percentage and fraction of that cost, they can not just acquire or partner with us to serve the customer. So it's a win-win relationship. Financial institution of this country find an advantage in partnering with Paytm because the reach it offers and access to the customer, which they were not bothered about, or they were not able to capture out, or they were not able to service the customer at a cost that they were operating at. It's good, not zero-sum, but a wholesome game.
Okay. On credit, Vijay, again, I want to understand the game here on credit. There are some, fintech companies which have in their, documents have suggested that there is a credit cost element even to this sort of pushing loans, even if you're not manufacturing the loans. But in your case, it doesn't seem to be the case. Do you have any credit cost element when you, push out loans on your network?
So, Ira, I'm going to tell you a little bit of academic statement here that in RBI in June 2020 came with a digital lending platform guideline, where it clearly called out what a digital lending platform can offer. For example, like it can offer reach, it can charge for these services, and it clearly called out that the customer belongs to the creditor, the lender. Customers KYC to customers credit and customers underwriting completely belongs there. So it is non-compliant completely for anybody to attempt to build credit distribution using digital platform business by offering some sort of risk guarantees, because risk guarantee is what a credit company does. So in our business model or in our AOP or in our MISs or numbers that you see, you don't see that because we don't offer that. We don't offer that. And another important factor here is that by virtue of not offering this, by virtue of partnering with deep-pocketed lenders, you said HDFC, we have HDFC, ICICI, Clicks, Aditya Birla Finance, tons of banks and NBFCs in the queue. We are able to extend more array of credit choices to a customer, and at the same time, customer has a higher probability of getting a credit. If we were thinking about becoming a creditor, then we would have taken a bank license and an NBFC license and done that.
So for you, it's a simple fee story.
it is, and one, we offer them distribution, so there is a distribution money that we can make, and then second, we obviously help them collect because we are the one who is receiving the money. So that's a.
But there's no implication on you if this credit proves to be bad quality.
Actually, the answer is that the creditors are far more concerned about it, and that is why of 100 people that we would give them, not 100 ever get credit approved. I mean, you would have seen Paytm postpaid ad in the newspaper yesterday, and we clearly called out that our NBFC partner, which is Aditya Birla Finance and Pledge Capital, have a sole discretion, complete discretion to issue this or not.
Understood. I think Madhur is back. Madhur, we'd lost you. If you can hear me now, Madhur, are you there?
I apologize.
Okay, sorry, we lost you. We were discussing credit and merchant. We got through that. If I can come to you a little bit on costs, actually, and just numbers. So last couple of years, you've seen a decline in expenses, particularly on the payment processing charges side as a percentage of GMV, and also in terms of marketing and promotional expenses. Can you talk us through both those elements? On the processing charges, is there more of a runway down, or you're now pretty much at a steady state? And on marketing and expenses, that's going to be volatile, right? As you grow some of these businesses as merchant, etc., it's tough to commit that you will keep a lid on marketing and promotional expenses in a hyper-competitive market like this.
Yeah, I think payment processing charges will continue to come down, or at least we have seen that trend. I don't think I should necessarily talk about next quarter or the quarter after, but we've seen that trend quarter on quarter, right? Even the numbers that we put out for June last in the RHP that yesterday will show that it has declined compared to FY21, right? So there is continuous room to improve that. With respect to marketing and promotion costs, yes, it is sort of dependent on what we want to do. But what I can tell you is that our decrease of 85% over the last 2 years, we used to be sort of 3,000 type of crore numbers. And now last year we did about 500 crores. That 85% decrease is because of just being a lot more efficient, right? In terms of how we acquire customers, making sure we acquire the right customers who we can retain without having to give them cash back on every transaction, be more efficient with our brand marketing and so on, right? So yeah, it has gone down quite a lot. I don't, quarter on quarter, that number might change. But and as we grow our business, maybe that absolute number could grow as well. But we feel quite good about the levels at which it is at in terms of percentage of revenue or percentage of GMV and so on.
Okay. There was a note in the DRHP at least, and I was sort of curious as to know why, that the company has moved away from 4 reportable segments, and you now work on a single segment. You're saying you don't allocate operating costs and expenses, assets and liabilities across business units. Can you explain to me why?
Well, that's just a function of how Vijay described the model, right? That customers and merchants come in through payments, and that sort of builds the habit, even if it generates a huge amount of GMV, generates a lot of revenue, generates contribution profit. But then those same customers and merchants with very little incremental CAC start using commerce, cloud, financial services. So we think it would be quite sort of almost arbitrary to say that financial services business or segment got a customer at 0 cost, or they got it at 100 rupee cost, or they got it at 1,000 rupee cost, right? So how do you allocate these costs? Because bulk of the customer acquisition and that habit building is happening actually in the payment side, right? So should we assume that those financial services customers just have access to those, financial services segment has access to those customers at 0 cost or at some cost, or and be quite arbitrary that way, right? So we run a single P&L within the company, right? So we say, okay, there's a cohort of customers coming. Some of them, all of them will want to do payments, let's say. Some of them may want to do commerce. Some of them may want insurance products. Some of them may want a lending product. Some of them may want a wealth product. And we should do the right thing by that customer. And we should do the right thing by that merchant, regardless of which product is making more money or which product is sitting in a certain segment or the other, right? So we think as a company, just given the model that we have, a single segment works better. We have shown revenue breakup within payments.
But not expenses.
Yeah, payments to consumers, payments to merchants, commerce, cloud, and so on. So we have shown revenue breakup because we thought that would be important, and that is easy to, there's no arbitrary sort of assumptions within that, right? There's just revenues from those segments.
Vijay, a question on Paytm Payments Bank. Is that going to become a larger and larger part of your overall empire, if I can use that word? And is the eventual game plan to, apply for a small finance bank license? I think you've spoken about that in the past. I'm curious as to whether that will stay. And a subsidiary question: if you do apply for a small finance bank, does the structure of the holding need to change for that entity?
So, one of the most important things that you should see is that Paytm, the entity 197 communication that we're talking about, is clearly committed to be the distributor of financial services in partnership with its associates and affiliates or partners. In that case, Paytm Payment Bank is just one of the entity, and Paytm Payment Bank is, as we know, is one of our affiliate and associate. The keyword here is that let's say credit is an example. If we get a small finance bank, one extra incremental thing that we get is a credit. But the 197 model continues and will remain so. Paytm Payment Bank, in best case scenario, could be a percentage fraction of what credit opportunity that we offer to the other lenders. Neither the Paytm Bank will have an obligation, nor 197 will have an obligation to be the flag bearer of each other. Because the reason is that Paytm Bank has its own business and its own customer base, which has a particular type of need and servicing requirement, and that has no bearing on what Paytm or 197's business is. And in other words, whether it becomes big and it becomes small finance bank, that would not increase or decrease in other scenario our upside or a downside. So one thing that is very, very clear is that Paytm's business model is out there clear. We have learned it, by the way, on a basis of number of factors, that it is far better to onboard large number of customers and large number of merchant and businesses, and then bring them host of financial services in partnership with companies that we work with. And Paytm Payment Bank is just one other partner there.
Okay, I'm being told I'm running out of time, but I have two last questions. Vijay, I'll stay with you on this one. A couple of governance issues, Vijay. I think the DRHP had really revealed that there was a large related party transaction on the insurtech side between you and the company. There are a couple of call options between you and Paytm Payments Bank, you and the insurtech company. Would you benefit from sort of a little bit of distance between you as a person and an entity and some of these, organizations? Because it does seem like everything is really intermingled and tough for investors, at least, to make a...
It's not. The regulator clearly asked domestic domicile obligation to be majority owner in payment bank scenario, and that is what I was. And I sold my equity in 197, which Madhur very fondly in many other investor communications says that would have been a lot more valuable than the equity value that which probably lower there. Okay, so so I was asked by regulator completely clearly that you are expected to get a clean money by selling your equity and get that invested, and you are expected to hold this in your equity individually in your name as a domestic obligation. The commitment that I have given as a individual to the 197 or Paytm shareholder is that whenever regulator is allowing, this equity has a ROFR, 197 has a ROFR, or Paytm has a ROFR on that. That is where it is. So it was regulatory governed. And similarly, in the insurtech cases, they are all not driven by individual, but driven by
and that proposed borrowing, Vijay, that proposed borrowing.
So one of the thing was that there was a discussion that we would do the borrowing through 197, but very clearly we knew it that if there was an approval from IDA coming very ASAP, then we would have done it. But we now are clear that I'm taking credit from outside. So I'm borrowing from outside, and it's a market borrowing on my own shoulders. And then I'm holding this company for Paytm so that when approval comes, it can be merged there. I mean, it's incidentally, surprisingly, if you go zoom in, then you find out that, oh, so you are holding it for someone and keeping it as a business, because Paytm's business of insurance requires approvals at different stages, and then buyer whom we are buying it from has an obligation to sell it at a particular timeline. To bridge it, I'm also taking the loan from outside here.
I should just say in simple terms that if Paytm could own 100% of these companies day one, due to regulatory things and so on, we would. Right? So there's no intention of sort of bringing in the founder and this and that. It actually creates more complications with respect to, like Vijay was saying, he had to sell his own shares in Paytm, which would have been worth maybe 6x, 10x today than it was 4 years ago, to be able to fund the bank. And on the back of it, he gave a call option to Paytm to be able to buy his shares, right? So his upside is sort of capped, and his upside that he could have had on Paytm shares is now gone. So it's not a great deal, but yeah, if we could get that
It's for the structuring obligation of India's entities and regulations.
Okay, and Paytm Payments Bank got pulled up by the RBI just a couple of days back. What was that about? I believe there was some information which was not accurately presented.
Yeah, there was a transfer of the BBPS business which we're doing from Paytm to Paytm Payments Bank as required by the regulations. And I think there was some understanding that it was already done versus it was getting done and so on. So RBI has put a fine of 1 crore on Paytm Payments Bank, and we respectfully accept that.
Vijay, last question then. We've talked about the minutiae, but you're best at communicating the big picture. So, we've seen Paytm transition over the years from, pure payments to payments plus to, bank folded into the bigger company, payments bank at least. Where do we see Paytm or 197 go from here over the next few years? What's the vision? What's the story?
So one of the things that I in last 2-3 years have seen is that customers are far more comfortable with this device for nearly everything that they do, which is exactly the vision that we always envisaged. And this has got ramped up in these pandemic years. Paytm brings your financial life, whether it is today we are saying payments, and obviously in partnership with other partners, banking, credit, and over the period insurance and other services, how deeply it will be seamlessly integrated using smartphone in your life. So when you go on a hospital and you scan a QR code, now you would have more asset classes to make a payment from. So Paytm is all about making multiple asset class liquidity available in real time. And that we have always said, that if you make the consumer win for the financial services that consumer is picking up. So, one of the things I want to also say here is the fact that financial services penetration is small in this country is shockingly for the reason that financial services industry locks the money of the customer. If I open a bank account, मेरे पैसे एकदम से गायब होना चालू हो जाएंगे, या फिर कुछ चार्ज लग जाएगा, या फिर मैंने एफडी बनाया तो मेरे से चार्ज कर देंगे कि मेरे को पैसे चाहिए, और अगर मैंने म्यूचुअल फंड में पैसे लगाए तो जस्ट बिकॉज मुझे आज चाहिए मेरे से फिर पैसे ले लेंगे. तो मैं ये नहीं कह रहा कि इन इंडस्ट्रीज की कॉस्ट नहीं है, मैं ये बिल्कुल नहीं कह रहा. इन इंडस्ट्रीज के पास बहुत सारे प्रॉफिट भी हैं. मैं ये बताना चाहता हूँ कि इस इंडस्ट्री की ऑब्लिगेशन है कि हम अपनी जो कॉस्ट ऑफ ऑपरेशन है वो टेंड टुवर्ड्स जीरो लेके आए. एंड speaking of the where your mouth is, as they say, is we brought payment to zero price in this country. And now I can tell you that we would continue to champion our Paytm Payment Bank, our affiliates bank account is a zero fee bank account. Zero fee, no obligation of keeping a balance. Zero fee debit card. You can take a digital debit card for zero fee. Incidentally, Ira, I want to tell you that I believe because financial institutions in past of all kinds have been not able to give the comfort of that money will come and out easily as you wish to or when you need to, is the reason people don't come to formal financial system. And that change is what the success of Paytm will be. So in 2-3 years or next 4-5 years, what visually you see? Oh, so you brought the number of people very comfortably paying, now number of people opening and operating bank account, number of people taking the credit, number of people taking an insurance. And that I think will be the success of Paytm, that we will make a common and comfortable with formal financial services and make it reach to the nook and corner of the country.
All right, I'll leave it at that. Madhur, Vijay, thank you so much for your time here on BloombergQuint. Thanks for watching BloombergQuint.
Bye.